Bankruptcy is the death of a company. Or is it? American Airlines, Trump's Plaza Hotel, Hertz, superhero company Marvel, those are just a few of the big name companies which are very much alive despite having gone bankrupt. They managed to do this by using the right type of bankruptcy. You see, there are actually 6 different types of bankruptcy. Each is named after the chapter of federal law that describes it, from Chapter 7, 9, 11, 12, 13, and 15. Now, Chapter 7 bankruptcy is the most common type of bankruptcy, and it's what most people intuitively think of when they hear the word bankruptcy. In a Chapter 7 bankruptcy, a company will sell all its assets and shut down permanently. In contrast, a company that enters Chapter 11 bankruptcy does so with the hope of actually coming out the other side stronger. As we'll see in this video, there are things that can block that from happening, but according to Forbes, about 25% of companies do make it through Chapter 11 and become successful again. So what benefits does Chapter 11 bankruptcy give to a company in debt? Well, all 6 types of bankruptcy actually serve the same general purpose as far as the government is concerned: to protect struggling debtors, people who owe money, from creditors, people who are owed money. The Supreme Court emphasized this in a 1934 case where their decision statement said that bankruptcy gives to the honest but unfortunate debtor a new opportunity in life and a clear field for future effort, unhampered by the pressure and discouragement of pre-existing debt. Now, putting aside the 100-year-old language from that statement, the reason the government cares is that people, and companies, with crippling debt don't spend money in the economy and they don't pay a lot in taxes. The government would rather let investors and creditors take a loss than the economy and government revenue take a loss. And that's self-evident from the fact that in every type of bankruptcy, certain tax debts cannot be forgiven. Nevertheless, bankruptcy is generally good for debtors and bad for creditors. Now, there are 5 common ways in which bankruptcy can help debtors. Number 1, debt collectors can be temporarily blocked by court order. That gives the debtor breathing room to figure out how to proceed. Number 2, certain debts can be erased. 3, debts can be renegotiated according to a payment plan that has lower payments, possibly extending over a longer time span. 4, the debtor can break certain contracts, such as leases, without any penalty. And 5, the debtor can reset certain contracts that have gone into default. Now, which of these tools are available and for which contracts, that depends on the type of bankruptcy the debtor uses. For Chapter 11 bankruptcy specifically, the primary benefits to the debtor are 1, an automatic block on most debt collection that lasts for the duration of the case or until the judge orders otherwise. 2, the debtor has the choice to break any executory contract without penalty. Now, an executory contract is any contract which it's incomplete on both sides. For example, ongoing service contracts, retainers, and unexpired leases. An example of a non-executory contract would be a prepaid purchase agreement where one party has already paid for something but the debtor hasn't delivered it, and the debtor cannot cancel that kind of contract. Third, some debts can be reduced or eliminated if enough creditors agree, but importantly, not all creditors have to agree for that to happen. Now, if we switch to a creditor's perspective, bankruptcy is typically bad. Creditors don't want to have the debts they are owed reduced. For that reason, creditors will often race to try to collect debts before a company files bankruptcy. However, there are rare instances when a creditor might actually prefer bankruptcy, and they can file what's called an involuntary bankruptcy petition to make that happen. The main reasons why a creditor might do this include maybe the debtor recently sold or gave away assets that the creditor wants to collect. The creditor wants to undo that transfer using the fraudulent conveyance doctrine, and they can do that through a bankruptcy. Or maybe the creditor is worried that the debtor will fraudulently transfer assets in the near future, so the creditor files an involuntary bankruptcy to prevent that. Or maybe the creditor is worried about the debtor paying off favored creditors and leaving nothing for them. Or maybe a small resource-constrained creditor is worried about other bigger creditors getting to the debtor first and collecting all the assets before the small creditor can. Involuntary bankruptcies do happen for all of the reasons above, but they are relatively rare. In the rest of this video, we'll focus exclusively on voluntary bankruptcy, where the debtor has filed themselves for bankruptcy. Now, what is the outcome of a Chapter 11 bankruptcy? Well, bankruptcy is a legal process that just determines who gets what when there's not enough to go around. The Chapter 11 bankruptcy process in particular provides a set of rules for a company in debt to renegotiate its debts and other contracts. The goal is to reduce the burden of debt payments so that the company can survive and eventually pay back more of its debts than it would be able to if it just shut down altogether. Now, if the negotiations are successful, then the debtor, creditors, and court will make a new set of agreements described in a document called the Reorganization Plan. The Reorganization Plan is the centerpiece of the entire Chapter 11 process. It will describe what existing contracts can be canceled, including any existing stock that will be canceled, what new contracts will be created, including any new stock that will be issued, any assets the debtor will sell, any mergers or acquisitions the company will undergo, and who will lead the restructured company after bankruptcy. Will it be the existing management team, or will it have new leadership? Creating, agreeing upon, and implementing the reorganization plan is the entire purpose of Chapter 11 bankruptcy. So that's the what and the why of Chapter 11 bankruptcy, but what about the how? How does it actually work procedurally? Well, here are the exact steps. Step 0 is pre-bankruptcy planning. Before a company even enters bankruptcy, it realizes that it's approaching insolvency and it will start talking with bankruptcy attorneys. If it decides on Chapter 11 in particular, then it will retain a bankruptcy attorney, and then it will choose a jurisdiction. Now, the choice of jurisdiction is extremely important in Chapter 11 cases, because a bankruptcy depends on both federal and state law, and even the specific judge involved can have a large influence on what happens in a Chapter 11 case. Now, many companies will choose to file in Delaware if they are incorporated in Delaware. Next is Step 1, filing a bankruptcy petition. The company will file a petition for Chapter 11 bankruptcy with the court in the jurisdiction it chose. This petition can be either accepted or rejected, so its acceptance is not automatic. If the petition is accepted, then the petitioner is referred to as the debtor and is considered to have officially entered bankruptcy. The debtor can submit a reorganization plan at the time of filing with the petition or at any point during the case. Next is Step 2, the automatic stay begins. As soon as a Chapter 11 petition is filed, the bankruptcy court will automatically order a type of injunction known as an automatic stay. What that means is that it's a court order which temporarily suspends and prevents any foreclosures, debt collection activities, and property repossessions by creditors. That gives the debtor critical breathing room. Step 3. The debtor in possession role is assumed. Once bankruptcy begins, someone must serve as a fiduciary of the debtor's assets on the creditor's behalf. In many types of bankruptcy, including Chapter 7 bankruptcy, it's common for the court to appoint a trustee called the case trustee to take control of the debtor's assets during the case. However, because the entire point of a Chapter 11 bankruptcy is to give the debtor a chance to restructure its debts and survive, it's much more common for the court to allow the debtor to retain operational control of its assets during the case. If that happens, which it almost always does, the debtor is referred to as the debtor in possession. The debtor in possession does not have total freedom like it did before entering bankruptcy, however, but it can essentially operate as normal when it comes to normal business operations. Oversight of the debtor in possession is primarily done by the Us Trustee. Now, not to be confused with a case trustee, the Us Trustee is the subcomponent of the DOJ, or the Department of Justice, which is responsible for overseeing the administration of bankruptcy cases. Responsibilities of the U.S. Trustee include monitoring the debtor in possession's operation of the business, monitoring any reports and fees submitted by the debtor in possession, conducting a meeting of the creditors, called the Section 341 meeting, determining and imposing requirements on the debtor in possession. Those requirements may include filing monthly income and operating expense reports, establishing new bank accounts, paying employee withholding and other taxes. If the debtor in possession does not comply with the U.S. Trustee's requirements, the U.S. Trustee can file a motion to have the Chapter 11 case dismissed or converted to another type of bankruptcy, such as Chapter 7, where the debtor will be liquidated. The debtor in possession is legally required to pay a fee to the U.S. Trustee every quarter until the bankruptcy case is closed, which is just another expense that makes bankruptcy an expensive process. Now, getting back to the debtor in possession themselves, one of the first priorities of a debtor in possession is to evaluate whether they have enough money to finance the bankruptcy proceedings and also continue operating as a business. If not, then the debtor in possession will need to get a special type of loan called debtor in possession financing, or DIP financing. Ordinarily, a creditor would not want to lend to a company that's already in bankruptcy because, well, the company can't even pay its existing debts. However, bankruptcy law provides a solution. If a lender provides DIP financing, then it will get priority over existing creditors to get paid back. It gives a lot of protections to the lenders who provide DIP financing, but it's not great for existing creditors, and the longer the bankruptcy case drags on, the more money will potentially be paid to the DIP financer, and the less money might be available to the existing creditors. So that's the ordinary case, the debtor in possession. There are cases of special concern, however. Now, if the U.S. Trustee or an equity owner of the debtor is concerned about fraud, dishonesty, incompetence, or severe mismanagement of the debtor's current affairs, then they can request that the court appoint a case trustee to manage the debtor's affairs during the case, rather than leaving the debtor in possession of its own affairs. In the absence of such concerns, it's still possible for the court itself to appoint a trustee if it determines that doing so is in the best interest of creditors. However, it's rare that a case trustee is ever actually appointed in a Chapter 11 case, and there's good reason for that. Creditors or equity owners who are concerned about credit management should carefully weigh the costs and risks of a trustee before requesting one. These costs and risks include a case trustee essentially becomes the debtor's new CEO. It may be difficult to find a qualified CEO on short notice, and expensive to hire them if you do find them. It can be even more expensive than hiring a CEO normally because the individual has to also take substantial risk to involve themselves with a bankrupt company. A company going through bankruptcy is also one which is already under considerable stress. That means that the trustee will have very little margin for error when learning to operate the company, yet they won't have the existing relationships with suppliers, employees, and other partners. A misstep could easily destroy any remaining value of the company. For concerned stakeholders, there is an intermediate option, though, between debtor in possession and case trustee. In this intermediate scenario, the debtor remains mostly in possession. However, a second party called an examiner is appointed to conduct any investigations into the debtor's affairs, rather than leaving such investigations to a potentially dishonest existing management team. The role of an examiner is highly flexible. The court can essentially authorize an examiner to have anything from minimal investigation powers up to almost full trustee powers. Now, examiners are also not commonly used, but they can be a good solution for large companies with questionable management teams. Step 4. Committees are formed. As soon as practical after the automatic stay begins, the U.S. trustee will appoint some of the unsecured creditors to serve on a committee called the Unsecured Creditors Committee. No creditor is forced to serve on the committee if they don't want to, but typically unsecured creditors will want to serve because the role gives them power to influence the direction of the bankruptcy case. Typically, the committee consists of the 7 largest unsecured creditors. Now, the U.S. trustee also has the power to appoint additional committees of creditors and/or equity owners if it believes that doing so is necessary to ensure adequate representation during the bankruptcy case. One of the first roles of the creditor committees is to participate in a meeting with the U.S. trustee and the debtor called the Section 341 meeting. This meeting is an opportunity to question the debtor under oath about the debtor's actions, conduct, property, and case administration. There's a section called 1103 that describes the full powers and duties of committees, but 2 key powers are, 1, the right to investigate the actions and finances of the debtor, which is very valuable to a creditor, and 2, the right to request the appointment of a trustee or examiner if they are severely concerned. Step 5. The first day motions are filed. If a debtor is under serious financial pressure, they will often file first day motions with the court as soon as the bankruptcy process begins. In court, a motion just means a request made to the judge. First day motions commonly include things like a request to maintain existing bank accounts, to maintain and provide assurances to utility companies so that the lights are not turned off on them, to honor customer deposits, and to pay pre-petition debts to critical vendors that the debtor needs to maintain a working relationship with in order to continue operating during the bankruptcy case. Step 6. Post-petition disclosure statements are submitted. Now, as I mentioned earlier, the ultimate goal of the Chapter 11 process is to create a reorganization plan and to reach sufficient consensus among creditors and equity owners for that plan to be accepted by the court. However, before any class of creditors or equity owners can vote on a proposed plan, a disclosure statement must be provided. The same or different disclosure statements can be provided to each class of creditor and equity owner, but every individual or company in a particular class will receive the same statement. That is by law. For every class, the disclosure statement must contain, quote, adequate information, which is legally defined. Now, what exactly constitutes adequate information is case dependent in general, but must always include a discussion of the federal tax consequences of the proposed plan to the debtor and to the hypothetical typical investor in that class of creditors or equity owners. So, essentially, this disclosure statement says, creditor, here's how this plan will affect you in a tax manner. Here's how it will affect your finances. Here's how it will affect your overall payback. Before any version of the disclosure statement is sent out, however, a court must hold a hearing and formally approve the statement as containing adequate information. This hearing passes no judgment on the merits of the plan itself, but it merely looks at the merits of the disclosure statement of the plan. Is there sufficient information for creditors to vote on this plan? If a plan is rejected, revised, and resubmitted as a materially different plan, then new disclosure statements will need to be approved and then sent out to creditors and equity owners. Now, an important note here. Neither the disclosure statements nor the reorganization plans are required to comply with ordinary non-bankruptcy rules about the sale of securities. Not something that the SEC is a fan of, and something that you should definitely be aware of if you are an investor or a creditor of a public company that is going bankrupt. Step 7. The reorganization plan is proposed. So once we have the disclosure statements, the reorganization plan can go forward. Now, the reorganization plan has the power to wipe out huge debts and to cancel stockholder ownership rights. Because of that, Chapter 11 law provides specific rules about who can propose plans and who can vote on plans. During the first 120 days, or 4 months of a bankruptcy case, only the debtor can propose a reorganization plan. This is called the exclusivity period. Now, if the case is complex, the bankruptcy court has the power to extend the exclusivity period up to a maximum of 18 months. If the debtor and creditors have not agreed on a reorganization plan by the end of the exclusivity period, then creditors can also draft their own plan proposals to be voted on, and that's usually bad for the debtor. Now, a word of terminology. A very common jargon word in Chapter 11 plans is impaired. A creditor is impaired by a reorganization plan if the creditor's contractual rights would be altered by the plan. So that could mean I'm a lender and I have a loan agreement with you and you're the debtor, and perhaps the plan says that the monthly payments are going to be reduced and extended over a longer period of time. Then I would be an impaired creditor. Now, 2 minor caveats to this definition are 1, a creditor is considered impaired even if the contractual alterations are net positive to them. So perhaps I'm that same lender, everything remains the same except the interest rate goes up. That's positive for me. I'm not harmed in any way, but I'm still considered impaired. And the second thing is that a creditor is not considered impaired if a debt in default is reset to a pre-default state. So again, suppose I'm a lender, you're the debtor, I have lent you money, you have not paid me for a certain amount of time, the contract is now technically in default, I have the right to collect all of my money at once. However, that can be reset and I'm not considered impaired. So those are 2 sort of minor caveats. Now, plan requirements. There are specific requirements in the bankruptcy code about what provisions must be included in any proposed plan. 4 of the most important are 1, the different categories called classes of creditors. For example, unsecured creditors, creditors secured by liens on company-owned trucks, creditors secured by a mortgage on a particular property, etc. 2, which classes of creditors would not be impaired under the plan. 3, which classes of creditors would be impaired under the plan and how. And 4, a description of any mergers or consolidations that are part of the plan. Those are essential requirements that must be included in any plan. Let's talk about payout priority. Given that companies enter bankruptcy when they don't have enough money to pay all their obligations, a very important question in any bankruptcy is who gets paid first and who gets paid last. By default, any reorganization plan must pay out in a particular order. First, secured creditors are paid, then unsecured creditors are paid, and finally, interest, such as equity holders, are paid. Commonly, secured creditors are paid back in full, unsecured creditors are paid back only part of what they are owed, and interest equity holders, such as common stockholders, often don't get anything. However, not all unsecured creditors are treated equally. The Bankruptcy Code actually specifies a particular order for specific unsecured debts to be paid back. First, case administrative expenses have to be paid, such as to the court. Second, wages and commissions for employees and some independent contractors of the debtor up to $10,000 each that were earned within the last 180 days before bankruptcy was filed have to be paid. Third, contributions to any employee benefit plan in compensation for services within the last 180 days, up to $10,000 per employee, minus whatever was taken out already for wages, that has to be paid back. Fourth, any unpaid debts to farmers and fishermen up to $4,000 per individual farmer or fisherman have to be paid back. Fifth, deposits put down for the purchase of property or services or the lease of property up to $1,800 per individual depositor. Sixth, taxes and government penalties have to be paid. Seventh, unsecured claims to banks have to be paid. And eighth, liabilities for deaths or personal injuries have to be paid. Now, after hearing all of that, it might seem like general unsecured creditors, which don't fall into those categories, are pretty screwed. To be frank, they often are. However, they're not necessarily as screwed as you might guess. The Chapter 11 bankruptcy process itself is expensive, and there are legal protections that make it difficult to pass a reorganization plan if some creditors get little to nothing. Because secured creditors are often risk-averse banks who would rather take a small loss and move on than risk more time and losses from a drawn-out bankruptcy litigation process, they will sometimes agree to give up some of their payout to the unsecured creditors so that the plan can move forward more quickly. Step 8. The reorganization plan is voted on. Now, to be accepted, a reorganization plan must be voted on using a particular type of voting. To describe that voting system, I need to make a tweak to what I said earlier. I've been referring to classes of creditors. Technically, we are not talking about classes of creditors, but classes of claims. A claim is basically a debt. It's not a nuance worth mentioning in a high-level overview, but it does affect the voting process since technically it's classes of claims which vote, not classes of creditors. And I'll explain with an example. If a single creditor holds multiple types of claim, then it may cast its vote multiple times with different weights in each class of claims it is a part of. Let me explain again with an example. Suppose Shoelaces Inc. files for Chapter 11 bankruptcy. Bob has an unsecured claim for $130,000 against Shoelaces Inc. Alice has an unsecured claim for $50,000. Candace has an unsecured claim for $70,000 and a secured claim for $50,000 secured by a shoelace making machine. Drake has a secured claim of $10,000 secured by a computer server. There are 3 classes of claims against Shoelaces Inc. if you listened. There's unsecured, there's secured by shoelace machine, and secured by computer server. In the unsecured claims class, Bob, Alice, and Candace all have voting power. Alice has 50,000 unsecured claim class votes. Bob has 300,000 votes, and Candace has 70,000 votes, so the total is 420,000 unsecured claims class votes. In the secured by shoelace machine claims class, only Candace has voting power, 50,000 votes out of 50,000 total votes. In the secured by computer server claims class, only Drake has voting power, 10,000 secured votes out of 10,000 total secured by computer server votes. Now, each class of claims will vote individually on a proposed reorganization plan. A class of claims accepts the plan if creditors holding at least 1/2 of the claims in number and 2/3 of the claims in amount vote for the plan. For example, Bob votes for the plan, but Alice and Candace vote against it. Then Bob satisfies the 2/3 requirement since he owns 71.4% of the total claims amount, which is greater than 2/3. But the vote for the unsecured claims class fails overall because less than 1/2 of the claims holders voted for the plan. Now let's talk about owner votes. While less important than the creditors, owners, often referred to as interest holders, also get to vote on plans, and they are also divided into classes. A class of interests, for example, common stock A, common stock B, preferred stock, etc., accepts a plan if holders of at least 2/3 of that class of interest vote for the plan. This is the same as for the classes of claims, except that we don't have the 50% requirement stacked on top. Now, there are a few special rules. If a particular class of claim or interest is left unchanged by the reorganization plan, then that class is automatically considered to have accepted the plan. Similarly, if a class would not get anything from a proposed plan, for example, common stockholders are often such a class in the case of a public company that files for Chapter 11, then the class is automatically considered to have rejected the plan. Additionally, if the court believes that any creditor or interest holder is not acting in good faith or is acting against the rules of bankruptcy, then that creditor or interest holder can be excluded from their classes from any votes by court order. Additional special rules also apply if any creditor or interest holder has agreed to a plan that was drafted before the debtor actually filed their Chapter 11 petition, and that's called a pre-packaged reorganization plan. Finally, we have step 9. The reorganization plan is confirmed. Now, to be confirmed, a reorganization plan needs to meet both legal and class voting requirements. The full list of requirements is provided in section 1129A of the Bankruptcy Code, but the main ones to remember are these 7. Number 1, the plan needs to contain all the information required by the U.S. Bankruptcy Code. 2, any payments made by the debtor for services related to the bankruptcy case, such as legal expenses, consulting expenses, forensic accountants, etc., those need to have been approved by the court. Third, the proponent of the plan, which is usually but not always the debtor, has disclosed the identity and affiliations of any individuals who would become officers or directors of the debtor under the plan. Fourth, any government regulatory commission with jurisdiction over rates of the debtor, this mostly applies to utility companies, has approved any rate changes before the plan is confirmed, or the plan's confirmation is contingent upon those approvals. Fifth, for each class of claims or interests that is impaired by the plan, typically either each holder in that class must have accepted the plan, or each holder in that class must get property with at least as much value as they would have received under a Chapter 7 liquidation bankruptcy. Sixth, each class of claims or interests has to have either accepted the plan or must be contractually unimpaired. 7, if any class of claims is impaired under the plan, then at least one class of impaired claims has to have accepted the plan. For purposes of this requirement, no acceptances by insiders count. Now that seems like a lot of requirements, and it can be. So what happens if the reorganization plan isn't confirmed? Well, if the parties of a Chapter 11 bankruptcy case cannot come together and pass a reorganization plan, then there are 3 scenarios that might play out. The first is called cram down. It is so named because the plan is crammed down the throats of dissenting creditors. If any impaired class does not accept the plan, then the only option to confirm the plan is by using a cram down. The full rules for cram downs are somewhat complex, but the 2 key requirements are that the plan does not discriminate unfairly, which has a precise meaning, and essentially means that one class of creditors is not treated worse than another unless there is a business or contractual reason to do so. The second is that the plan is fair and equitable with respect to each class of impaired, unaccepting claims or interests. Again, the meaning of fair and equitable can be complex, but one of the main implications is that higher priority classes must be paid fully before anything is paid to lower priority classes. The second situation that can happen is called conversion. If parties can't agree on a reorganization plan, then usually at the debtor's request, the case can be converted into another type of bankruptcy, such as a Chapter 7 bankruptcy, where the company is liquidated and shut down. Finally, the third scenario that can happen is that the case is tossed. If the court decides that the debtor has not been acting in good faith, then the court may toss the case and leave the debtor to be ravaged by creditors through ordinary debt collection procedures. So let's say that we do confirm the plan. Once the reorganization plan is confirmed, there are still things that need to happen before the debtor can officially exit bankruptcy. Any conditions that the plan is contingent upon must be met. For example, those rate approvals by government agencies. Second, the plan has to actually go into effect. Now, the effective date is the effective date of the agreement as a contract, and that's usually at least 10 days after the confirmation date. Finally, the court has to issue a discharge for any debts and liabilities of the debtor in accordance with the plan. And then finally, the bankruptcy case can be officially closed by the court. Now, I know this was a pretty dense video, but I wanted to provide a complete overview considering that there are a lot of Chapter 11 cases with big crypto companies that are going on right now. I wanted to give you guys an idea of the complete process from beginning to end of what's involved in a Chapter 11 case, who the players are, and what the goal is. So if you appreciated this in-depth video, give it a like, it'll help out my channel, and I'll see you guys next time.